Right now, in a warehouse in Shanghai, a manager looks at a cavernous space that once held 5,000 metric tons of silver. Today, his ledgers show roughly 715 tons remain. That's an 86% drawdown. And he has a problem. 50 industrial buyers are demanding delivery this month. Some are so desperate they're offering to pay premiums on the spot. This isn't an isolated stockroom issue. It's a signal. In October 2025, China executed a stunning pivot, shipping approximately 660 tons of silver to London in a single month, enough metal to fill 22 double-decker buses. Why London? Because analysts indicate the vaults there are running critically low, suggesting the global physical market is nearing a breaking point. History shows us this script. Not once, but 3 times in the last century, similar conditions have led not to gentle rallies, but to explosive re-evaluations. 1933 to 1935, government intervention and mandated purchases drove silver from $0.28 to $0.81 per ounce, a near tripling in 2 years. 1971 to 1980. The collapse of the Bretton Woods system unleashed a 37-fold multiplier, taking silver from $1.29 to a peak near $48. 2008 to 2011. In the wake of financial crisis money printing, silver quintupled from under $9 to nearly $50 in 3 years. 3 different eras. A repeating pattern of monetary stress, physical scarcity, and dramatic price discovery. Think of this pattern like a game of musical chairs. Stage 1. The music plays. Everyone dances. The market appears normal. Stage 2. Chairs begin to vanish, quietly removed. Few notice because the music continues. Stage 3. The music stops. Panic. A sudden collective realization there aren't enough seats. Stage 4. A frantic fight for the last remaining chairs. Many market observers believe we have just heard the music stop. We are now in Stage 3. Let's examine the historical pivot points, the exact moments the music stopped in the past. April 5, 1933. President Franklin D. Roosevelt signs Executive Order 6102. It's not a request. It's a mandate. Americans must surrender their gold to the government at a fixed price. Compliance is compulsory. But the government's focus doesn't end with gold. The 1934 Silver Purchase Act follows, authorizing the Treasury to buy silver at above-market prices. The goal? Control the metal to control the money. The result? Physical scarcity drives the price, not utility. Silver nearly triples in 24 months. August 15, 1971, a Sunday night. President Nixon appears on national television to deliver a shock. The United States will no longer redeem dollars for gold. The cornerstone of post-war finance is shattered in a sentence. Why? Because foreign governments were draining Fort Knox, swapping paper for physical gold. September 15, 2008. The collapse of Lehman Brothers triggers a global cardiac arrest. The response? Unprecedented monetary life support. The Federal Reserve's balance sheet balloons from $800 billion to over $4 trillion. Savvy investors move into tangible assets. Coin shops sell out. Mints backlog. Silver, from under $9 in 2008, rockets to approximately $50 by April 2011, a 5-fold increase in 3 years. The pattern is clear. Crisis, monetary response, a flight to physical, and a dramatic price revaluation. But notice the acceleration. 1933 to 1935. 2 years. 1971 to 1980. 9 years for the full move. 2008-2011. 3 years. The cycles are compressing. The current cycle arguably began with the pandemic money printing of 2020. We are 5 years in, and a confluence of data suggests we have just crossed the threshold into Stage 3. So, What's different this time? Why could this cycle be more acute and faster than any before it? Because a powerful new variable has been introduced: insatiable, inelastic industrial demand. This isn't just a story about investors and money printers anymore. It's about the physical metal required to power the modern world. March 2020, the pandemic hits. Governments unleash an estimated $20 trillion in liquidity within 18 months. But beneath that tidal wave of money, a quieter, more fundamental shift was underway. The industrial juggernaut, solar power. Each gigawatt of solar capacity requires roughly 1 million ounces of silver. China alone installed over 250 gigawatts in 2024, potentially consuming 250 million ounces just for its solar boom. Electric vehicles. Every EV uses 1 to 2 ounces of silver. Global production is accelerating exponentially. 5G and AI. New infrastructure. Data centers and electronics that didn't exist a decade ago all depend on silver. The numbers are staggering. According to the Silver Institute, global industrial demand has surged past 1 billion ounces annually, while mine supply has plateaued around 813 million ounces. The result? A structural market deficit. We are now in the 5th consecutive year of a physical shortfall, with a cumulative deficit from 2021 to 2025 reaching approximately 820 million ounces. That's metal consumed but not replaced. For years, this reality was masked by the paper market. On exchanges like COMEX, for every single physical ounce of silver in registered vaults, there are an estimated 100 to 400 paper claims. Banks and institutions have held massive short positions, selling promises to deliver metal they may not physically possess, artificially suppressing the price. But something has broken. The link between paper and physical is fraying. The proof is in the panic. 1. The Chinese pivot. After years of accumulation, China flipped to a massive net exporter overnight, shipping 660 tons to London in 1 month. This isn't charity. Analysts believe this metal moved because London was running dry and the premiums were irresistible. 2. The lease rate spike. In London, the rate to borrow physical silver, the lease rate, reportedly exploded from under 1% to an annualized 39%. This is a nuclear-grade signal. It means holders of real metal are refusing to lend it, fearing they won't get it back. 3. Air freight. Traders began air freighting silver, a metal so heavy and bulky it almost always travels by sea. You only pay for air freight when you need the metal yesterday. This is stage 3. The music has stopped. The scramble for chairs has begun. The catalyst for stage 4? Right now, the COMEX shows a staggering leverage ratio, over 800 million ounces in open paper contracts, backed by roughly 40 million ounces of physical silver available for delivery, a 20-to-1 ratio. If even a modest percentage of contract holders decide to take delivery of real metal, the system faces an existential challenge. It may be forced to settle in cash, shattering trust and triggering a stampede into the physical market. Industrial users won't wait. A solar panel production line halts without silver. These buyers will pay any premium to keep their factories running, bidding the price away from paper speculators and into the hands of those who hold the actual bars. We stand at the convergence of all 3 historical patterns: 1933-style government intervention, 1971-style monetary reset, and 2008-style financial panic and money printing. The velocity of information and the scale of industrial demand make this potentially the most explosive cycle yet. The question is no longer if the physical market will reassert control, but when. And when it does, history suggests the move will be rapid, dramatic, and leave paper promises far behind. This is not financial advice. It is an analysis of patterns, data, and historical precedent. The evidence suggests we are witnessing a critical inflection point. The decisions made now, whether to secure physical metal, understand the risks, or simply watch the signals, will define outcomes for years to come.